is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Welcome back to another week of DeFi Decoded. I am Andrew Young, and unfortunately my co-host Alex Tapscott cannot be here, but no matter, because we have an incredible guest this week, and I'm really excited to have him on the pod. So this week we have Ben Jacobs, who is the managing partner of Scenius Capital. Ben has been investing professionally in the digital asset space since 2021, with a focus on both liquid and private strategies. He also hosts Scenius Studio, which is a podcast that features leading investors and sort of showcases the most compelling use cases emerging from the industry. Scenius Capital is a pioneer in the digital asset space. Sort of, I'll let Ben sort of explain it more, but it's kind of one of the first true quote unquote fund of funds in the crypto space, and has a lot of experience sort of investing in portfolio funds, co-investment, direct investment, and they operate out of the US, but invest globally on behalf of a diverse set of international investors. So really happy to have Ben on this week's episode, and welcome.
Yeah, thank you, Andrew, for a great introduction. As the host of Scenius Studio, I'm always the bridesmaid and finally the bride, so it feels good. So excited to chat.
Yeah, it's great to finally have you on the pod. I would love to just start with, what was your journey into the digital asset space? How did you sort of get involved in this I guess relatively niche sort of subsector of the industry?
Yeah, so I'd say it's two-pronged. The first is what got me into crypto at all. And the truth is I just graduated from Vanderbilt University in 2015. And I was still in test-taking mode. So I figured, why not take the GMAT in case I wanted to go to business school. And for standardized tests, I always had done very well in the verbal portion of these tests, but my math score was a little behind. And I knew what I wanted to get. And so I Googled best GMAT math tutor in New York City, and I saw this guy had nothing but 5 stars and glowing reviews. But I saw that his hourly rate was exorbitant. But I figured with 2 weeks leading up to the test, maybe he had some type of secret sauce or some methodology that could help me get the score I wanted. So I booked a session with him. I'll never forget, it was the dead of winter, and he showed up in Birkenstocks and cargo shorts and a Hawaiian shirt. So you knew he meant business from the moment I met him. And for the first 2 hours, it was just straight intense math. And at the end of the session, he said, you could pay me full freight in cash, or I'll give you a 50% discount if you send me Bitcoin. And that piqued my interest. And it was almost like a sensei type moment where he deliberately said it to kind of intrigue me. And I was like, oh, you take Bitcoin? And he was like, oh yeah, Bitcoin, Ethereum, like whatever you want. I prefer that. And I asked him why, and he said it's the most important technology of our time. And these are some of the most important assets of our time. So this guy, who clearly was exceptionally bright, piqued my interest, and I asked him to do another session, but this time just focus on crypto. So I ended up taking the GMAT. I did well, not as well as I would have liked, and I ended up not going to business school. But more importantly, I became obsessed with crypto. So this guy became my mentor, my tutor, and taught me not only about Bitcoin and ETH and blockchain, but about the general philosophy of money and how governments and the Fed interact with the money supply, the importance of digitalization, or decentralization, the erosion of trust and centralization, and these broader themes that, as an impressionable consultant, which was my full-time job, just kind of resonated with me. I don't know if it was a rebellious streak that I had, or I just wanted to find my own thing to take and run with, and I just became obsessed with it. So I was working a full-time job as a consultant. I started buying BTC and ETH with a little bit of my paycheck every 2 weeks. Managed to convince my dad to put a little money in, managed to convince my mom, my brothers, my friends, and bit by bit, I became the evangelist within my network. So I migrated out of consulting into high growth tech, where I was at a couple startups working in strategy and ops, all the while doing crypto on the side. And fast forward to 2020, I was in LA, and my now wife was stuck at her family home in Tucson, Arizona. So there really wasn't too much to do during COVID. And so I just started reading everything I could about crypto. And I wasn't a trader, which was how the majority of people participate in the asset class. I was far more oriented towards buy and hold and just be patient. And I wasn't technical, so I never really knew how to participate beyond just what I was currently doing. But then with the rise of DeFi summer and the discussion around social tokens and DAOs and NFTs and all of this stuff percolating, I thought that there was enough meat on the bone that I could find a way to participate in the asset class more wholesomely. And so I decided to quit my job and just figure it out. So I started writing a Substack, kind of sharing my discoveries in crypto and beyond, just cool stuff I was figuring out on the internet. And then I had the idea that there were people who were making way more money than I was in crypto by being very active. And I was like, like, who are the best investors in this asset class and how could I align with them? So I just Googled, together with my brother, who's now my partner, best crypto funds. And I had never been an LP. I'd never been a GP. I didn't know anything about the professional investing world. And what was interesting about that point in time was you could get in touch with anyone. There were so few LPs out there. Even if you were writing a 100K check, you could get in front of some of the biggest GPs, brand names in the asset class, and speak to them one-on-one over Zoom. So that's what we started to do. And through that process, we started to get a sense of the liquid hedge fund, the venture fund landscape, what the different strategies were, what was going on from like a service provider standpoint, just like the infrastructure of the investment management space. And ultimately, my brother and I wanted to pool our assets to invest in a basket of funds. And at that point, we started socializing the concept to people in our network. And people were like, hey, if you stand up some type of vehicle, I'd love to give you some cash to invest alongside you. Seems like a good way to approach the asset class in a diversified, diligenced way. And you're getting exposure to, hopefully the best active managers. So that kind of was the kernel of insight that people were willing to pay for that type of exposure and that type of access. And so we thought, you know what, why don't we stand up our own vehicle and see what we can do? So at that point, we had to decide whether to raise a venture vehicle or a hedge fund vehicle. And we ultimately decided to invest into hedge funds. So we created the Digital Assets Opportunity Fund, which is our fund of long bias discretionary liquid token hedge funds. And we started off with our GP capital, and fresh out of the gates, we raised $3 million from friends and family. And it just kind of grew from there. And that was in May 2021 was our first month. So now that is one of the longest tenured fund of hedge funds in the asset class. And so that vehicle continues to operate and invest and take in investors and deploy to underlying strategies. We have a soon to be multi-year, 3.5-year audited track record that we're very proud of. And that's been a great vehicle. In addition to that, we knew that there were other profiles in this asset class that people wanted to get exposure to, primarily venture. And so we started canvassing the landscape of venture managers. And what we realized was that the majority of them absolutely suck, and that they do no diligence. They had raised way too much capital. There's no valuation sensitivity. And I frankly don't think the venture managers had any sort of edge beyond just being early to crypto, which, as someone who was early to crypto, I didn't think I was capable of running a direct venture strategy. So why did these people? So by speaking to a ton of managers, and because we knew how to diligence hedge funds at this point, we had a pretty robust, rigorous due diligence process where we could really flush out how well these venture funds understood their domain that they specialized in, or just a space at large. And we arrived at a thesis that we thought was differentiated, was that small emerging managers that had been carefully selected and combed through had the highest probability of generating outperformance above the benchmark. And we consider the benchmark like the beta of the asset class on the venture side. So like the Andreessens or the large funds of that size. So we recently closed that vehicle. We raised a $20 million fund of emerging manager VC funds, where we've been actively deploying into these strategies where the average fund size is 36 million. So we're looking for fund one and fund twos that have a clear edge in a domain, whether it be a geography, whether it be an ecosystem like Solana or Bitcoin, whatever, or a sector like consumer or gaming or DeFi or AI. So our hope is that in this one vehicle, we have exposure across a number of different vintages, a number of different geographies, a number of different sectors. Couple other things that I'll just hit on, and then I'll pause because I know this is the world's longest intro, but I figure it's best to get it all out of the way, and then we can get into the fun stuff. Also host a podcast where I interviewed GPs and CIOs, as Andrew alluded to. So took my inspiration from Ted Sedes of Capital Allocators and Patrick O'Shaughnessy of Invest Like the Best. So did 50 evergreen episodes with GPs and CIOs, hedge funds and venture funds. And now I'm doing a mini series focused on use cases. And then also through Scenius, given our unique vantage point, operating a liquid fund of hedge funds and a fund of VC funds, we've launched an investment banking arm where we're servicing crypto native businesses. So that's it in a nutshell. I'll pause there and happy to answer any questions. Go from there.
Yeah, I mean, there's so many angles we could take this, but I think like the first, I want to get down to like current market dynamics and things that you're seeing, but kind of the first question I have, and I think probably a lot of our listeners have as well, is when you look at traditional hedge funds, you can sort of classify their strategies into different buckets. You know, you can have quantitative fund, you can have long short, you can have like factor-based funds. Leaving aside the venture for now, just within the liquid crypto hedge fund space, because I think this is actually where there's like by far the least amount of information. You know, as someone who's in the industry day in, day out, like, and raised from investors, I still don't really know what liquid funds do. Can you just kind of like, what does the universe of liquid crypto hedge funds look like? Like, what are the strategies they pursue? What are kind of like what's like the alpha that they typically sort of generate? If you can just kind of like break open that, because you probably have the most insight potentially in the world on liquid crypto hedge funds. So let's just start there.
Yeah, happy to take a crack at it. So basically there's passive strategies where you could buy ETFs, you could buy spot assets and kind of hold them. Like that's one way to invest liquid, right? And that's pretty obvious. The other world is the active world. And then within the active world, there's a whole host of different strategies that serve different investor objectives. So the concept of beta basically means like how this asset will return versus a general benchmark. So there are a bunch of funds that are high beta funds that are effectively a way to get exposure to the asset class in a way where they're selecting specific assets. So a lot of those are long bias discretionary funds where they may be buying Bitcoin, Ethereum, Hyperliquid, Aave, Uniswap. They are selecting assets that they've underwritten and constructing a portfolio that they think either is the perfect way to get exposure because it's just like a blanket way of covering the entire asset class, or they might try and generate outperformance by rotating among different assets. So this is probably the most common and the largest AUM strategy. So an example of this would be Fund X has 40% of their portfolio in Bitcoin at this point in time. They might have 20% in Sol, 20% in ETH, and then the remaining 20% is allocated to a range of slightly longer tail assets. That calculus and the portfolio construction would rotate depending on where we're at in the cycle. So now, Bitcoin has been clearly the top performer, but for a while, a lot of these hedge funds didn't own any BTC. They owned all the alts you can think of. However, alts performance have dragged considerably versus Bitcoin. And there was always this rub, like, we shouldn't be paying you 2 and 20 to own Bitcoin. But the reality is, like, it makes sense to have it as part of your portfolio. And actually what you should be diligencing these managers on is their ability to rotate capital pending on market movements. So do you want to be like, what percent of your portfolio should Bitcoin constitute? The other majors like Sol and ETH versus the longer tail token opportunities. So a lot of the work that those hedge funds are doing is underwriting some of those longer tail opportunities, like which actually have some product market fit, which have fundamentals, where the narrative's kind of working, and how can they kind of front run some of those opportunities before other hedge funds or family offices or prop shops or retail start buying them. That's one part of their job where they could generate actual alpha. The other side is the rotation. So how do they protect capital, go risk off to cash or stable coins? Or how do they protect capital by getting out of alts and consolidating into the flight of quality to the majors? So let's call that the long bias discretionary bucket. To make it simple, the other side of it, let's call like the low beta, less correlated side to it. You could, kind of call it market neutral-ish. So basically, these strategies try and take advantage of arbitrage within the markets or other non-directional strategies. So you might have a fund that is doing cross-exchange arbitrage. There's a slight price differential, and they'll be trading that difference until that trade goes away, just because the alpha has kind of eroded. There might be yield farming, where you're supplying liquidity to a new pool, and as a result, you're getting some yield, but then you might get some points that then convert into tokens, and then you sell those tokens. So it doesn't really matter where the price of Bitcoin or ETH is in these types of environments. Sure, that might impact the volatility, which can have implications on the returns that these lower beta strategies may have, because the greater the volatility is, the more optionality is, and like funding rates and leverage and yield farming, blah, blah, blah. So that's a totally different strategy. Where it gets really interesting. So, and then the third is everything in between. Some, like there might be some momentum trading, trend following, blended strategies where you turn on you have multiple strategies running concurrently, and depending on where your portfolio manager kind of oversees the broader market, might overweigh some strategies versus another. But what I've actually found to be quite interesting of late is allocating to these lower beta strategies using Bitcoin, ETH, or Sol as the base asset. So you might be subscribing in kind in Bitcoin. They're not selling that Bitcoin. They are then borrowing against that Bitcoin, and then using the USDC that they've borrowed, using the BTC as collateral. They are now able to do these low beta trades or yield farming opportunities or anything under that window, and they can earn anywhere from 10 to 30% in returns, but they will denominate it in Bitcoin. So you are maintaining the beta, the Bitcoin, but then you're earning 10 to 30% net of all fees, more Bitcoin on an annualized basis. We found that to be very attractive as a way to gain exposure, to maintain the beta, but to increase your base asset. And those funds tend to be a little bit more liquid, no lockups, no quarterly redemptions with 45-day notice. It's monthly liquidity, monthly redemption. So each of these funds have different terms. But yeah, the majority of the capital is in those long bias discretionary funds, the multi-coins, the Panteras, the Parafis. They tend to have those strategies. They may also have a lower beta strategy, but the lower beta strategies tend to have less AUM at this given point in time.
Yeah, that's a first of all amazing overview. So it kind of in some ways like broadly it mirrors the traditional sort of hedge fund, but obviously with a crypto flavor. The idea of a Bitcoin plus is really really cool because the funny history of crypto hedge funds, from my perspective, having participated in a couple, is the long only ones absolutely crush it during a bull market. Typically, I mean maybe not this cycle as much, but typically they've crushed it in a bull market. At least last cycle they did. But then obviously you have the huge downside vol when the market gets when the market collapses. Whereas the market neutral ones are just print constantly. But then the problem is Bitcoin's up 200% in a year and this thing's still up 30%. Relative to a normal fund, that's amazing. But obviously when Bitcoin's going up 200%, it seems kind of weird. So this Bitcoin plus idea is really, really cool. It kind of sounds in a lot of ways what Bitcoin Treasury companies are trying to do though. So I guess like that's interesting because if you sort of think it through, that should be what like a Bitcoin Treasury company should be effectively doing in a way, is earning a Bitcoin per share yield or whatever. I maybe like taking this a little bit different direction. Kind of curious what you think about the rise of the digital asset treasuries. A lot of our audiences in the TradFi world, they're probably a lot of people don't understand how you put like $1 into a stock and get $2 out of share price or whatever the MNAV is currently. I think it's typically in like the 1.5 to 2 times ratio. Can you just kind of compare and contrast like what you think about, I guess maybe just what you think about these digital asset treasuries and maybe compare and contrast that with just like crypto hedge funds in general?
Yeah, I mean, there's a huge amount of capital that is incapable of custodying digital asset tokens directly. And these digital asset treasury companies have emerged in the wake of MicroStrategy's success as a way for anybody with a brokerage account to access crypto in a wrapper that is easy for them to custody, own, etc. So the strategy we've seen, MicroStrategy is unique because it has such a robust business and it was the pioneer, and Michael Saylor is able to leverage the capital markets to be able to borrow and purchase BTC and generate all these derivative instruments on top of MicroStrategy that allows it to command a sharp premium to its underlying assets. What's been interesting to see is there are certain markets like London or Japan where you can't really access like a Bitcoin ETF yet natively in those countries. So companies are being formed, often like these are shell companies or there's some type of like SPAC or de-SPAC and reverse merger or some way of bringing a company public, or where the strategy will be to purchase some underlying digital asset. It could be BTC, it could be ETH, it could be SOL, it could be Hyperliquid. And their promise is to then make that base asset productive. So buy other maybe staking companies or stake the assets or find other ways to generate a yield and a return. And what they do is they basically are offering these people in these countries an opportunity to buy this company, which is effectively a proxy for the underlying digital asset with the hope of yield. So some of these companies right now command a premium because there's a share price that's higher than the value of the underlying asset. So say there's $1 billion worth of Bitcoin, they're trading as if the assets of the business are 1.5 billion. So people are willing to pay a premium to have exposure to these companies because they think there's narrative and the Bitcoin price will continue to go up and that these will follow the micro strategy trajectory.
So yeah, I have a slightly different take on it. I think, like, to me, because I initially was kind of baffled by these digital asset treasuries, you know what I mean? Just like the fact that these things are trading at a multiple to the NAV. And I understood in the past cycles when there was no Bitcoin ETF, but now there's a Bitcoin ETF, so you can get one-to-one exposure if you want. And I think what I'm realizing now is that Bitcoin treasury companies are sort of a way to get like, almost like, I mean, I wouldn't call it low cost, but get leverage on your Bitcoin effectively, right? Like it's almost like a way where you can get leverage without a liquidation level. I mean, I totally agree with you on the other side on terms of like the bond markets, and the preferreds. Like those are types of assets that you can't get exposure to crypto directly, and so taking advantage of that makes a lot of sense. But yeah, I mean, we'll see. I'm the funny thing is I was incredibly skeptical, and I'm slowly coming around to them to a certain extent. I mean, I think if they can do what you're kind of talking about, though, like a Bitcoin plus, like that's the type of thing that, if you show really good management and you're able to increase Bitcoin per share through strategies, like that's a really, really cool thing. Okay, let's switch to we have. Sorry, yeah.
I was just going to say, just quickly juxtaposing them to the hedge fund strategies. Listen, they're far more liquid. They're you don't have to diligence a manager. You can kind of diligence a company. However, like I think there can only be so many of these that are successful. And over time, everyone's trying to find a unique way of expressing themselves. Like we're launching this strategy that's going to do this, and we're raising this amount, or this is our underlying asset. And eventually there's going to be insufficient buyers that there's going to be a discount to NAV for many of these. So I do think there will be some huge winners where for the reasons you mentioned and the reasons I mentioned. And I think there's going to be many losers, and people are thinking that these early ones are going to be the winners because they're early.
Yeah, no, I totally agree. I mean, I think it's clear that there's a reflexivity also like aspect to this, which on the upside is amazing and probably means we're going to get 140, 150K Bitcoin potentially by the end of the year, or maybe 200K like the bulls think, but it's not going to be, or I guess UD thinks 400K maybe by the end of the year, but there's going to be reflexivity on the downside and it's going to be vicious. Okay, I really want to talk about also the venture side because it's a totally different game than the liquid crypto side. Like the venture is interesting because often crypto venture seems to be, like, again, from my perspective as just like a founder in the space, fully agree with what you're talking about. Huge delta between VCs. Like some of them are incredibly sharp, like do their due diligence. Others are way less so. Mostly care about kind of like short-term tokenomics, like sort of nonsense stuff. How do you? Okay, so like I guess maybe just the same sort of question I had on the liquid asset side. How do you see the sort of the venture space? How do you break it down? Like any trends you're sort of seeing in it as well, like just kind of give us the lay of the land in the crypto venture market.
Yeah. So, I mean, there's a couple ways in which you could bucket them. So the first is, are they a generalist VC, meaning that they may invest in AI and robotics and also crypto as a component part of that strategy? Or are they, pure crypto? That's the first distinction. The second is size. And then you could get into, like, are they a $10 million fund or are they a $2 billion fund? And then you could start, cutting it even further down. As I mentioned earlier, do they focus on a geography? Do they focus on an ecosystem? Do they focus on a category like a DeFi or AI or something like that? I think there are many excellent venture investors out there who are very thoughtful about the technology's strengths and weaknesses, the realities of what launching a company or protocol in crypto looks like, and some of the headwinds that founders have to deal with ambiguity, effectively launching and becoming a public company before, a normal company would by launching a token. So I think there are a lot of VCs that have great insight into the crypto world and just like how to launch a token, how to think about picking a chain, how to think about token design, how to think about scaling a team and ultimately decentralizing. I think those are all important things. My gut is that venture returns are going to compress slightly to what they were in like 2017, 2018 vintages, because there were so few VC funds then. There was such little competition, and you could be blind and throw a dart and you were going to hit 1,000x by some being early to some DeFi app. I think those days are largely over, and it's way more competitive. And as a result, a lot of the funds that, were successful in those early vintages that couldn't replicate it won't be able to raise additional capital. And I think the funds that will be most successful are ones that are able to adapt to the game on the field. So how do you adapt to the game on the field? I think there are two things going on. The first is being able to underwrite liquid tokens. So being able to buy, either by going directly to the company and going through the foundation, buying tokens through the team, even if the token is live, it just may be underpriced. There may not be a lot of liquidity. So, hedge funds are not willing to buy it. There could be a myriad variables that are implicating. So I think the savvy venture funds are not afraid to deploying into liquids. That then gives them some optionality in that they can also exit those positions probably much faster than a traditional venture investment, which could have some long vesting period. The liquid stuff could also have a vesting period, depending if they go through the foundation, but just something to keep in mind that one of the unique elements of crypto venture is that you can exit and your liquid token positions typically far earlier than a traditional venture fund outside of crypto who's reliant on some liquidity event 7+ years out where there's M&A or IPO or something like that. So crypto venture has the opportunity for earlier DPI and distributions. The other, so like knowledge of the liquid token markets, I think is critical to being successful as a VC in this asset class going forward, knowing how to exit and then knowing how to underwrite liquid tokens. The other side I think is very important is if we're still an industry that is selling products to other crypto natives, then we failed. So I think what needs to happen, similar to how, starting in the 2000s, you were not a venture capitalist that could write a memo on being like an internet investor. Like, no, you were figuring out how the internet was going to disrupt shopping. How was the internet going to disrupt supply chain? How was the internet going to disrupt banking? And you were investing in companies around that. Same thing happened with mobile. Same thing happened with cloud. Same thing will happen with AI. Right now, if you're just like an AI company, that's not differentiated enough. You need to be an AI company that's disrupting this weird niche in accounting or in healthcare. And so crypto has been funded historically to service the crypto industry. So building infrastructure to support blockchain scalability, to support the UX, the experience to custody, all the market infrastructure, exchanges, et cetera, prime brokers, options, et cetera. Now I think this next era is, okay, like a lot of the plumbing to support the blockchain industry has been built. How will the blockchain industry permeate other industries? So the first indication of success is how quickly crypto has permeated the financial services sector. It seemed to be one that was ripe for disruption, and naturally crypto lended itself to. So you see that with stablecoins, you see that with cross-border payments, you see that in even borrowing and lending using, Aave, Morpho, etc. What will be next? I mean, we saw experiments with NFTs. We're seeing experiments in SocialFi. We're seeing novel ways to gamble. Everything from Polymarket to things like SX. So crypto is now, given that a lot of the core infrastructure has been solved, the best venture investors will be able to take their understanding of the weird nuances of crypto and its underlying technology and can think pragmatically about how that tech, paired with a founder who understands a different industry, could be uniquely purposed to solve a problem in a way that a traditional company could not. And I think that's where the biggest returns are going to come from. So I look for venture fund managers that, are highly engaged in the asset class. They understand its intricacies. They understand how it could permeate other industries. They're level-headed, and they're operating, not with a "I know everything" attitude. They're hungry. They're eager to learn. They're well networked, and they're researching every day. There's so much going on; it's impossible to stay on top of everything. So there's a broad spectrum there, but.
No, that's really good, and that kind of lines up with what I sort of thought as well. Like it's interesting because the crypto, there's a really big difference when you talk to VCs as a founder. VCs that are crypto is like one aspect of their fund versus like crypto is like their entire fund. Just because you can't possibly be up to date on everything that's going on in the space if you're not literally full-time living it. So, but at the same time, I sort of agree with you. There's a lot of like crypto VCs that maybe wouldn't pass the bar to be a normal VC if they weren't in crypto, in the sense that like they don't have like a high enough level of due diligence. So we're starting to see like the rise of some almost like Web 2 operators and investors that have now come in, like bringing the same level of due diligence that they had in sort of the Web 2 SaaS space, or just like the traditional financial system, but then bringing that into crypto. And that seems to be the combination that is exciting for me as a founder, because they're way more fundamental oriented, but then also like way more interested in the business and way more I would just say like more level-headed and long-term. So that's been cool to see. Okay, we don't have too much time, and I really want to get your views on the actual crypto sort of asset class itself. We're seeing a range of opinions on the show in the last couple of weeks. Some people think we're very close to the top. Others, we're seeing 200K, even 400K sort of Bitcoin price targets. We had the Bitwise CIO on last week, and he had this great. He made the case for sort of like 10K ETH by the end of the year. Maybe not by the end of the year, but sort of like within the next short while. Just kind of curious, like what you're talking to some of the smartest crypto investors in the world. Like, how's everyone sort of feeling? Where do you think we are? I guess. How are the funds that you've invested in sort of looking at this market, and as well as like how are you looking at this market personally?
So for how, as well as things are going, I can sense that both the liquid fund space and the venture fund space, your average fund is nervous, not because of the markets, but more so as they reflect internally on their business. So you look at, first, let's touch on the liquid space. A lot of these hedge funds have starkly underperformed Bitcoin. And as a result of that, they do not have a great story to tell when pitching LPs. And when you start having less confidence in an approach that is, centered around some combination of the majors and alts, it becomes difficult when the concept of an alt season where these longer tail assets outperform doesn't really exist. So as everyone wanted these ETFs to pass, but as they pass, and it's so easy now for large allocators to get exposure to the asset class, why would they, endure lockups and having to diligence funds and, deal with operational risks when they feel like they could just get, good coverage by buying some of the ETFs. So a lot of liquid hedge funds are looking at themselves like, how should I reinvent this strategy if there's a world in which alts don't perform? And then as you also think about that, you're like, who is going to be the next net buyer of these alts? Because, retail is no longer buying some random infrastructure alt. So if that downstream buyer is not available, then it needs to be institutional buyers or more hedge funds. And if hedge funds are not really getting inflows, then where does it go? So I think a lot of the long bias discretionary hedge funds are a bit lost. That's kind of my take right now. I think an alt season could totally change that. But it's just something to be cognizant of. On the lower beta side, I think the funds are actually doing really well because the operational infrastructure for the space has gotten much safer. So a lot of those funds were very active on centralized exchanges and were using OTC desks and leverage and et cetera. So in 2022 with Celsius, BlockFi, Three Arrows, Luna, FTX, Genesis all happened, those funds were hit the hardest and the majority of them lost some assets, which hurt their credibility. So now funds have much better operational infrastructure to protect themselves and better due diligence processes and risk management processes and systems in place such that they can operate more safely. So that has allowed them to get inflows. So they're actually more confident. And especially as prices go up and there is volatility, those strategies do well. And those returns, you're comparing them more so to traditional hedge fund returns. So as you said, 30% would sound astounding to some guy who's been investing in macro hedge funds. But, so that's the hedge fund side. The venture fund side.
Sorry, yeah, real quick. That I do want to hear the venture side, but it actually makes complete sense. I think like the liquid crypto funds, essentially what you're saying, got to benefit. They got to charge alpha fees for just giving access to
data.
Yeah, and whereas the market neutral funds have always really had to earn their keep, and the counterparty risk hasn't evaporated, but it's gone down tremendously. I guess I would think that the competition would get a lot harder. The market neutral guys I talk to are like, it seems like they're using a lot of their GP fees to reinvest into like building more trading strategies. Like it's becoming more and more of an arms race, but maybe that's just always been the dynamic. I guess curious on that, and then definitely want to hear what you're talking about on the venture side.
Yeah. Another thought that just came up is like, there's also this sense that there's this limited window where these market neutral, lower beta, more systematic type strategies can excel in this asset class before the very well capitalized, large traditional hedge funds, the Millenniums, the 0.72s, the Man Groups, the Citadels enter the asset class in force and eat up all the alpha.
But to be fair, what's funny though is when I first got into the space in 2017,
people were saying they're coming.
That was the story back then too.
But the reality is that they are, I don't know when, but now the path, especially with regulatory clarity, is much easier for them to envision. So they can't put capital and size yet in this asset class.
And also another thing too is the space is evolving to on-chain. So it's like right when the centralized space is getting regulated and maybe we can start to play there, like the hot ball of money is moving to the on-chain space, which is kind of like away from the regular, like, you know what I mean? It's funny because the industry is like evolving away. It's almost moving too fast for the regulation.
And two things on the longer bias discretionary funds that I think are interesting. One, there's been a fair amount of consolidation. So funds, there's so many funds in the 10 to $50 million range that just like can't hit escape velocity. And so there's consolidation there, which I think is probably healthy. The other thing is like the people who manage these funds are not stupid. They're very bright and they are finding ways to generate alpha. What does that look like? Digital asset trading companies, DATs, and finding ways to express theses in the equity markets. So owning Robinhood was a very successful trade. If you had a good, sharp indication of how Robinhood's crypto business was underappreciated, and if you had bought Robinhood prior to these tokenization announcements and like clearly like their path forward that's been very successful, that would have been a great trade. Owning, Shopify as a way to get stablecoin exposure, or even buying Circle on IPO day. Like those are ways that hedge funds have made money. So I think being a pure altcoin fund is over, and now being almost like a special situations hedge fund that's willing to go cross asset, cross venue, find different pockets of alpha that's available to make money is how these funds will ultimately evolve.
Yeah, totally. That makes a complete sense. I mean, those are also famous last words before the altcoin rally eventually hits.
Yeah, exactly. and it's coming. It's coming.
Altcoin market hedge funds are just going to rip. Okay, I really want to hear the venture side. Actually, why don't we start with the venture side, and then I'll save my last question for after that.
Yeah. So on the venture side, I think a lot of these funds are going to struggle to raise money. Not that they might struggle, but they may have to raise way smaller funds. So funds that, in 2021, 2022 that are finishing up those vintages now, they probably raise $250 million funds. They may raise 100. Can you keep your team incentivized? Can you keep, everyone excited? I don't know. That's like, does it make sense to continue? So that's one question, is like a lot of the funds that had some success may not be able to raise at the same size. And then therefore they have to start questioning some of their assumptions around team building and strategy and things of that nature. I think there's also been this decision around liquid token markets that's important. And then also just this constant debate of generalization versus specialization. So some funds that may have oriented themselves around DeepIn, that may have really worked, early, but now everyone knows about DeepIn. So it doesn't make sense to stay a specialized DeepIn fund. So do you find another vector to specialize in, or do you focus on, becoming a broader generalist fund? I think those are some of the calculuses that are going on in some of these GPs' minds. And then, like as I said, like for crypto to be successful, I think you need to know more than just crypto. So thinking about how crypto will permeate robotics and deep tech and sectors beyond financial services is important, because right now I can tell you there's a ton of money. It's very competitive in DeFi and stable coins and payment, and venture is a game of outliers. So if you're investing exactly where everyone else is investing, your chances of finding, and then the valuations go up as a result of that. The outlier successes typically don't come from that. So I'm looking for funds that are peering around corners and looking for information asymmetry, where they may have some novel secret about some ecosystem or some application of the tech that other people are not paying attention to.
Yeah, I think that makes sense. I think, like, to me, the interesting fund manager I would love to talk to would be someone who is also like an activist, because there's so many sort of crypto funds. There's so many like crypto projects that to me, at least in the altcoin market, and maybe this is why the altcoin market may finally get a rally, is there's a lot of absolute garbage in the altcoin market, but then there's also a lot of like pretty undervalued projects that just could use kind of like more marketing, more almost like a activist style campaign. Just to kind of like A, fix the tokenomics, B, and then B, like, obviously bring more eyes to them. That was also one of the interesting things about the crypto space. At least it's less so now, but when we first got involved, like, just because Polychain had invested in a token, it almost guaranteed its success. That seems like less the case nowadays, but just definitely you could kind of be your own catalyst as a crypto hedge fund manager, at least in the past. I would definitely say less so now.
Yeah, and I think that's one of the coolest opportunities out there is you can get into a protocol's governance and really help rip up how things are going and adjust the protocol's operations and capital allocation and change things around. And all of a sudden it can fly quickly simply because of low liquidity.
Yeah, makes sense. Okay, last question. How do you see the space evolving over the next 3 to 5 years? You sort of touched on the professionalization, at least on the market neutral side. Totally agree. I mean, we've already sort of seen that a bit. You talked about the consolidation on the long only side, and just like the fact that ETFs and digital asset treasuries means you can't charge alpha fees for beta exposure anymore. What's your outlook on the space just generally over the next 3 to 5 years? What sort of subsectors are you most excited about? Yeah, what are you looking at?
Yeah, I don't know if I'll say anything too novel here, but I do like my biggest bone to pick with the asset class is I could go months without touching crypto. Like there's no app on my phone where I use crypto on a day-to-day basis. So I think that is going to change, and most likely crypto will be, hidden underneath the hood if the team does its job well. But I could see a world in which I walk to a local coffee shop and I pay with USDC because it's embedded with their Toast POS system. I think that's going to happen. I think there is going to be financialization of embedded within social media apps. So I could see Twitter integrating prediction markets in some capacity, or there could be a way to buy and sell a tweet or buy and sell a song. Things of that nature, I think, will be more embedded. One thing, for example, is like having to buy a subscription for a newspaper or for a newsletter. Like, I think you'll be able to do micropayments quite easily and be able to buy, with one click, pay 50 cents in order to read an article. Those are things that I could see us using on a day-to-day basis with crypto underneath the hood, which would solve the question of where are the use cases. So those are kind of some more fun answers. I do think AI is quickly going to make the concept of truth very difficult, and blockchain is kind of really the only answer to that. So creating authentication, scarcity, and verification will be pivotal. I think over time, it's is this a real article from the Wall Street Journal that's being shared around? How can you verify that? Can you right click on the photo and see it came from an authenticated Wall Street Journal wallet that printed this article on chain? Those are versus anybody could spin up something that looks like the Wall Street Journal with some false headline and scare the crap out of people over something. So I think that is on the horizon and something I'm excited about. And then beyond that, clearly stable coins and payment rails and the financial services system will be run on blockchain. I think it'll be a gradual evolution. And I think in 3 to 5 years, we're looking at a 500K Bitcoin, and, ETH above 10K, and a couple other things that we're probably not even aware of breaking through the top 10.
Awesome. Well, there you have it. I can't wait for that. And I think we could all use 10K ETH on this podcast because we shell ETH all the time here. But it's finally gained its moment in the sun. Okay, well, this has been an amazing chat, Ben. Very unique sort of conversation for us. We've done a couple hundred episodes, and this is our first time talking to someone who's fully immersed in sort of investing in crypto investors. So really, really appreciate you coming on. For any of our listeners, you can check it out. Scenius Capital, it's scenius.capital. Is there any other sort of ways for listeners to hear your take?
Yeah, feel free to email me. It's ben@scenius.capital, or follow me on Twitter. It's Benny, BENNYP Jacobs. I really appreciate the opportunity to chat. And thanks for having me. And hopefully there was an insight or two in there, but I felt like I was rambling, but hopefully it was helpful.
No, it was super helpful. I appreciate it a lot. And we'll have to have you back on the podcast soon. Thanks again.
Amazing. Thank you.
And with that, that's this week's episode of DeFi Decoded. Please hit like and subscribe if you're on YouTube or your favorite podcasting platform, and we'll see you again next week.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.